ChatGPT has been absolutely everywhere recently, and people have been raving about just how useful it really is. So I thought today we'd put it to the test and see what it has to say about investing. As we go through these, if there are any investing tips that ChatGPT has actually given that you really strongly disagree with, let me know why in the comments below. And as always, on behalf of myself and ChatGPT this time, this is not qualified financial advice. So I asked it to generate 20 investing tips to help an individual achieve their financial goals. And this is what it gave. Number 1, start early. The earlier you start investing, the more time your money has to grow. Well, I can't really argue with this one. This is quite a standard investing tip. It comes down to basically compound interest, the eighth wonder of the world. Time is on your side with investing. The more time you leave your money to compound, the larger your pot will be at the end of that time period. It's quite standard stuff. The graph here really shows this fact. It shows the impact of when you start investing. So you can see that the blue line, this individual started at age 25 and he invested $200 per month. The green line shows somebody that started at 35 investing the same amount, $200 every single month. The red line, 45, again, $200 every single month. So with all other factors kept the same, these people just started at different ages. And you can see how crazy the difference is. The blue line is the one that started at the age of 25. And it's just exponential growth, so much higher, left with a much bigger portfolio than those that started later in life. Having said that though, I think it's important to highlight that if you don't actually start investing until your 30s, your 40s, whatever, it's still very much worth doing. If you look here, ignoring all other things on this graph because this is talking about market timing, whatever strategy you follow, you're going to have more if you invested than if you actually stayed in cash. So if you're going to start later, still worth investing. Next up, determine your investment goals. Decide what you want to achieve with your investments, such as long-term growth, income, or capital preservation. I do agree with this in the sense that making goals gives you structure, it gives you guidance, it sets you up with some habits, and that's really important in investing. But it also highlights this idea of whatever your goals are, such as long-term growth, income, whatever it may be. So it's sort of getting at the fact that you have these separate goals. However, what I think you can do is you can actually combine these. So you can chase long-term growth and you can also chase building a steady income. So it comes down to different investment strategies. For example, you can be interested in growth investing and dividend investing and value investing all at the same time. And you can have a mix of different things in your portfolio that reflect those different investment strategies. Next up, diversify your portfolio. Spread your investments across different asset classes and sectors to reduce risk. Now, this one comes down to this whole idea of diversification versus conviction, in my opinion. Diversification is something that is advised to everyone in the investing world. It's the idea of putting your eggs in many different baskets so that you lower your risk and you can sort of almost guarantee market average returns. However, if you don't want market average returns, or you don't want certain assets, or you perhaps really believe and you have strong conviction in just a couple of stocks, then I don't think there's anything wrong with that either. For example, it's telling us that we should have different asset classes. So you could have equity, you could have bonds, you could have crypto, real estate, you could even hold gold and stuff like that. But personally for me right now, I just have no interest in bonds because I think my money is better utilized elsewhere. So I do agree that for the average person, diversification is important to some extent. But I don't believe that you need to go all out and diversify in things that you just don't want in your portfolio. First and foremost, think about where your money is best spent. Next up, it's telling us that we need to consider index funds, as index funds can provide broad exposure to the market and may outperform actively managed funds over the long term. Now, I do completely agree with this. The best thing for the majority of people is to put their money into a passive, low cost, really easy ETF or index fund, perhaps one that's even globally diversified, so that they just put their money in every month and leave it to do its thing. And like I was saying, if this is a good index fund or ETF that is tracking a global market or a big market like the American market, you can pretty much guarantee that you're going to get market average returns. that is exactly what it's doing. It's tracking the market. I think the only problem with putting all of your money into index funds and ETFs for some people, not for everyone, is that they feel a bit limited by the idea of market average returns. They want to strive for more, or perhaps they don't really like the lack of choice. If they want 20% of Apple stock in their portfolio rather than just 3% that maybe an ETF is giving them or an index fund, that might not sit well with them. So the lack of choice may come into it as well. But I do think it has a really, really good point about better than managed funds. Managed funds can rack up loads of fees, so it's probably just better sticking it in an ETF, but not financial advice. Go and have a little research about that. The fifth investing tip that ChatGPT has given us is rebalance regularly. Rebalance your portfolio periodically to maintain your desired asset allocation. Okay, I think this is good in the sense that you are sort of staying disciplined. You're looking at your portfolio regularly. You're constantly evaluating whether it's the best it can be, and you're staying really disciplined with your investing. So I think in terms of what this makes you do, it's really, really key. And I do think rebalancing is important for people that have a certain determined percentage of different sectors or different stocks that they want in their portfolio. Go and check in and make sure that suddenly pharmaceuticals haven't gone to 20% when you wanted to keep them to maybe more like 15%. That has a place. But also I think there's something to be said for if you're constantly rebalancing at really regular time periods, you're going to take on more fees because you're going to have to probably pay when you buy and sell. Also, I think you've got to find what you actually want and what works for you, and don't rebalance just for the sake of feeling like you have to have certain percentages in your portfolio. There's lots of portfolios out there that tell you to have 60% equity, 40% bonds, this amount of pharmaceutical, this amount of banking stocks, whatever it may be. But actually just decide what works for you. And if you want a really high percentage of one thing over another, that's okay too. Next up, avoid market timing. Trying to time the market can be risky and difficult to do consistently. Yeah, I made a video on this recently. Trying to time the market rarely works because you've got to time it perfectly twice. You've got to buy the dip and then you've got to sell at the high to make it worth doing. It's also really stressful to do, doesn't really work. And instead of this, I think what investors should do, or my personal opinion, is that instead of trying to time the market really well, they should just, buy as they want to. And then if there's an opportunity in something they really want, i.e. a stock that they've been looking at has come right down in price, maybe they just use that as an opportunity and just put more money in at that time. Going back to this graph because it's useful here as well, this is a study showing what different strategies the effect that different strategies can have on your portfolio. So you can see that if someone was able to time the market perfectly, which is not really going to happen, they end up with the biggest portfolio. That makes sense. However, there's such little difference between that and just lump sum investing, dollar cost averaging, and even timing the market badly. Of course, you'd rather have the perfect timing portfolio than the bad timing, but I think what it shows you is just get rid of either extremes. So don't try and time the market perfectly. Don't do that and then fail and get bad timing. Just stick to one of these average, invest lump sum or dollar cost average. Before we move on to number 7, if you want to become a patron and get access to the exclusive Discord, it's £3 a month, which is cheaper than your weekly coffee, and check it out in the description below. I'd love to have some more of you over there. Invest in quality companies. Look for companies with strong fundamentals and a history of consistent earnings growth. I think this is subjective somewhat as to what defines a quality company. There are some really basic things such as looking at their fundamentals, their balance sheet, making sure that they're probably not going to go bankrupt in 2 years, stuff like that, and it's really important. But as to what defines a great company, it's kind of subjective. Warren Buffett will say that Coca-Cola is one of the many quality companies, and I think he's absolutely right. But other people will say that a growth stock is the best company, Microsoft, Apple, Tesla, whatever it may be. So it is somewhat subjective, but there are definitely things that you need to look into. And I think this is highlighting that point. If you are investing into individual stocks, it's really important to do your research and actually look at whether this company is going to be a good investment now and for the future. Number 8, keep an eye on expenses. High fees can eat into your returns over time. Yes. This is one that is so important. You might not think that a little fee here and a little fee there is really going to add up, but when you look at what that does to your portfolio over time, over many years, many decades, it's absolutely crazy. This is just showing us the impact of different expense ratios on a 6% annualized return over 30 years. So they're expecting 6% every single year to be returned from this portfolio over 30 years, which is obviously long-term investing. And these different investors, these 4 different investors, had different expense ratios, so different fees. You can see that the one with 1% fee has such a larger portfolio with everything else kept the same than the person that decided to pay 2.5%. Really, really important. Bear this in mind. ChatGPT is also telling us to not invest more than you can afford to lose. Invest only what you can afford to lose and avoid taking on too much risk. Yes, I do think this is important. Investing is meant to be a smart financial choice. And if you are having to borrow money or go into debt to invest, I don't think that's something that people should be doing, in my personal opinion. Again, this is all my opinion and ChatGPT's opinion. But I think it's more important to concentrate on building yourself an emergency fund, paying off high interest debt, all stuff like that first, and then move on to investing. It also mentions avoid taking on too much risk. I kind of disagree with this one because I think this is really up to the individual. It's subjective. It depends on their risk tolerance. It depends on their time horizons. It depends on their financial situation, how much they can afford to lose, their investing goals. All of stuff like this really comes into play here. And again, investing into one stock or into one industry or one asset class is going to seem risky for one person, but for another person, it may make complete sense. Don't panic during market downturns. Stay calm during these and avoid making rash decisions. I think this is exactly bang on the money. It's really important to keep your mind in check with investing. It is a psychological game mostly. You really need to get rid of all the FOMO, all the new news, all the noise, and build conviction in what you're doing and stick to it. If you see the market dip, don't panic about it. See it as an opportunity and accumulate more. So we're now halfway through. If you want to add anything to the 10 investing tips that we've just seen that maybe I missed, or you completely disagree, leave it in the comments below and let's see the next 10 investing tips that ChatGPT is telling us to do. Use dollar cost averaging. Investing a fixed amount at regular intervals can help smooth out market fluctuations. I think this is a good point. I think it's a good strategy. It really keeps you consistent. Just every single month, put in the allocated amount of money that you've determined you can invest into your investments and just repeating that time and time again. But what we also saw by that graph I showed earlier is that actually lump sum investing is pretty decent as well. So if you want to do that, fine. And if you want to do some lump sum investing and then maybe you change your mind or you see an opportunity, that's okay as well. The most important thing here is just to be consistent with your investing, whatever that means to you. Number 12 is consider tax implications. Be mindful of tax on your investments, such as capital gains. This one is so important. If you're here in the UK, try to invest through an ISA, which is a tax efficient account, before you start looking to have a general investment account where you're actually going to be paying dividend taxes and capital gains taxes. It's like with fees. Ideally, you just want to be keeping as much of the money as you possibly can. You don't want to be giving it up to taxes and fees where you don't have to. Avoid herd mentality. Avoid following the crowd and investing in popular stocks or trends without doing your own research. This one's so important. And again, it comes down to avoiding the noise and the FOMO that is out there. You really want to avoid emotionally investing and instead invest on strategy. Make your strategy and follow it. The thing that happens when loads of retail investors just rush to pile their money into one stock because they're all worried about missing out on the next big thing is that the stock price then shoots right up and it becomes overvaluated. The stock price no longer reflects the intrinsic value, and what goes up must come down. 14, keep a long-term perspective. It's a long game. It's important to stay focused on your goals. Yeah, I can't really disagree with this. You're either interested in long-term investing or you're interested in trading. Two very, very different things. Having a long-term mindset will help you see the value of leaving your money invested over time for compounding purposes, and also it will help you ride out market fluctuations. If you know you're investing for the long term and you can actually zoom out on charts and see that all the little market dips and, the volatility is just short term, that's exactly what it is, and it will go up over time, then you should be able to stay invested and not panic and sell everything when the market starts going down. Instead, seeing it as an opportunity. 15, stay diversified within asset classes. We've kind of touched on this one already, so it's repeating itself. It's running out of tips here. Maybe instead of this one of you guys can leave a good tip that actually ChatGPT has completely missed out. But yeah, what I was saying is it's all well and good diversifying, but also think about what you actually want. Don't diversify for the sake of it. For example, I don't want to put bonds in my portfolio right now. However, that's kind of the advice that you should mix equity and bonds. 16, use a professional advisor. Consider working with a professional to help guide your investment decisions. Obviously, talking to a professional advisor is going to cost a lot of money, so it's not accessible for everyone, unfortunately. It might be a really good thing for some people. Again, it's subjective. I can't imagine they're allowed to say too much unconventional advice. So perhaps if you're quite a stereotypical investor, it might be good for you, but they do offer tons of knowledge and experience. So it's completely up to you. I don't disagree and I don't agree with this one. It's kind of just there in the middle for me. 17, be mindful of investment fees. We've seen this one. We're not going to do this one again. Super, super important. It's quite funny that it's repeating itself. I only asked for 20. I should have stated do not repeat any or something like that. Avoid investing in just one company or sector. Don't put all your eggs into one basket. This is very similar to what we've spoken about earlier. Diversification versus conviction kind of thing. Yeah, probably not best to stick all of your eggs in one basket unless you have done so much research and you are so sure and you're willing to lose that money should it happen. But equally, who's to say that having 3 really good quality stocks is better or worse than having an ETF or whatever? I think it's really, really up to you on this one. Stay disciplined, stick to your investment strategy and avoid making emotional decisions. 1,000% agree with this. You really got to stay disciplined. You've got to know your goals and why you're doing it. And again, that will help you block out all the noise when things seem to be going crazy and everyone's telling you that this is it. This is going to be the time that the economy just shuts down and the stock market goes to zero. You have to be able to just block that out. And number 20, what's it going to hit us with for this last one? Stay informed. Stay up to date on financial news and trends to make informed investment decisions. I think if you have individual stocks in your portfolio, this one's really important. If you have like a couple of stocks or maybe even under 10, you should be really doing your research and staying on track with the news and things that are happening in that company. Because most of the news is not going to change your opinion, your intrinsic value of the company, the reason that you invested. But something might be going on in the news that actually makes you want to double check something or think about maybe replacing that position, whatever it may be. If you are an investor that prefers ETFs and index funds, which is also absolutely fine and a perfect strategy, you probably don't need to worry about this one so much. Maybe just keep an eye on the macroeconomic situation of the world, because in the S&P 500, for example, if you have that ETF, 505 companies, whatever it is, you cannot stay on track with every single one of those positions. Even if you had nothing else to do, it's too much. It will take too much time. So in that case, probably not. Just keep an eye on the news in general. But especially if you're putting all of your money into a couple of stocks or, even just one stock, definitely keep up to date and do your research. Super important. That was super fun. It was so interesting to see what Chatgpt had to say about investing. Like I said, if you disagree or want to add any, leave them in the comments below. Consider becoming a Patreon and joining the Discord. Would love to talk to you all about investing over there. And if you want to see another one of these, maybe where I look at personal finance or something like that, let me know. I hope you enjoyed this video and I'll see you again shortly with another one.